Hey guys, how's it going? It's Andy from Magoo Investing. Happy Friday. Yes, I finally was able to get a haircut after way too long. And I feel like there should be something like a dating app, but for finding a barber, because I came up to Portland, I'm in a new area, I don't have a barber. And in my mind, instead of trying to find a new one and just drive downtown somewhere, I drove 3 hours total back to my old town so I could go to my barber that I've been seeing for the past 5 years. So while I was driving, I wasn't really checking my phone. And then I got to my old town and I looked at my phone and I was like, ooh, that is a big sell-off. So in the past 48 hours, we've seen some massive sell-offs in the market. So far, at this point of recording, NASDAQ is down 3% on Friday. We'll see if that changes by the end of the day, but we are seeing some pretty large sell-offs. And for someone like myself that has been kind of predicting a large sell-off for the past couple months, it doesn't feel good that the market's selling off, but it is definitely needed. So in today's video, I wanted to talk about the only 3 stocks that I'm considering buying in September of 2020. In the past couple of videos, I've been talking about how, at this point, tech stocks are completely off of my list. I've bought into Zynga and Sonos, which are going to be long-term positions. But besides that, the rest of the tech industry is so overextended that I don't see any great deals. So in this video, I'm going to be talking about 3 stocks that are in beaten down industries that I think are still a good deal at this point. They're all down around 30% so far in 2020. And I think going forward, these are some of the best opportunities I'm seeing in the overall market. So I'm going to explain what I see in those stocks, and I'm very curious to see what you guys have to say about them in the comment section down below. Now that the market is falling, I would love for you guys to put some suggestions for video ideas in the comment section down below, because I kind of have a general idea of where I want to go with this channel. But if you have some ideas that you want me to discuss, I'm very curious to see what you guys have to say. Before getting started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is me just giving my own opinions on the stock market, and you need to do your own research. Also, if you've been enjoying these videos, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. With that out of the way, let's get started and talk about the 3 stocks that I'm looking to buy in September of 2020. Anytime I talk about stocks that are down so far in 2020, people are like, oh, why don't you just buy big tech? These are the stocks that I think are great deals at this point. At this point, I don't like anything else in the overall market, and these are literally the only 3 stocks I'd be considering buying at this point. When the market does sell off, I'm going to be making note of which stocks sell off significantly so that I can put them onto a watch list and buy them in the future. But right now, I'm going to let the overall market just kind of ride itself out, see what happens with this sell-off. But at this point, these are the only 3 stocks that I'd be confident buying right now. When we see the tech industry at this point, Apple is down 14% in the past 3 days. Microsoft is down 7% in the last 3 days, and then Zoom, which was up 40% after their earnings report on Tuesday, is down 23% in the past 3 days. So we're seeing some major sell-offs, and all 3 stocks that I'm talking about in today's video have been pretty resilient to the overall market sell-off, and I think that's very attractive. So with the second disclaimer out of the way, let's get started and talk about the first stock on this list, which is going to be JP Chase, ticker symbol JPM. So JP Chase is currently trading for $103 and is down 26% year to date in 2020. So far as the market is selling off on Friday, JP is actually green on the day, which I think is a very good sign when I've been talking about buying into these beaten down industries. In past videos, when I've talked about buying into sectors that you don't have a lot of experience with, I've always talked about buying either what is the largest stock in that sector or the one that looks the best going forward. And I think JP ticks both of those boxes. So at this point, JP is the largest bank stock when it comes to market cap. And then I think in the close second is Bank of America. And I do like Bank of America, but I'll talk about in a little bit why I think JP is more attractive in the long run. So one of the first things that I saw when I looked at JP has been their earnings growth year over year. From 2016 up until the first quarter of 2020, they saw more than a 5% increase in revenue year over year for each quarter. And so that is incredible growth. And when I put up the earnings, even when the last recession hit, within 2 years, their earnings were back to normal. And we've seen an incredible jump from $4 per share annually back in around 2010 to the point we're almost at $11 per share. And obviously 2020 is going to look a little rough because we saw a huge drop in earnings per share in pretty much every sector. So we're not going to see that for 2020, but they've had some incredible earnings growth, and I think that's fantastic when you're looking forward for a long-term investment. Looking at their debt to equity, it has been relatively stable, and it's currently sitting around 1.35. There are some sectors that do better with having high debt because it allows them to expand, buy more things. But when you look at the overall sector, you see a lot of these other stocks that you'd be considering for this industry that were relatively similar, with Bank of America being at 1.1, and then Wells Fargo sitting at 1.45. So seeing JP with a debt to equity over 1 isn't that alarming, especially considering how much money they've had to take out in loan provisions to make sure that they're protected going into this recession. So for the past couple quarters, I believe JP Chase has taken out around $20 billion in loan provisions. And so that's one of the big question marks going forward, is how bad is this recession going to be? At this point, we are officially in it, as we've had 2 consecutive quarters of GDP shrinkage, but it's going to be very interesting to see how that hits the average consumer. So bank stocks are not normally thought of as being great opportunities going into a recession. But one of the reasons why I really like JP Morgan is because of all the additional protections that were put in place after the last recession. We've seen that put in place recently with the stress test, which is done by the Federal Reserve to make sure that these bank stocks are having enough money set aside. And if they don't, then they're required to cut their dividend, which is what we saw with Wells Fargo a couple months ago. So going forward, even though we're going into a recession, or we are in a recession, I think bank stocks are in a much better spot. And so we've seen that with the money that they've put aside, they're planning ahead, and I think that's very attractive for a long-term investment. Obviously, this might be some short-term chop. Going into recession, maybe things don't go great, but I think for the long-term outlook on the company is very bullish overall, and buying the best stock in this financial sector is very attractive. And the thing that puts JP Chase above the rest of the bank stocks, besides being the largest when it comes to market cap, has been their investment banks, which has brought in $5.5 billion in revenue in the last quarter. And when you compare that to the $34 billion in revenue that they brought in overall, that's a pretty impressive number, and it has not been matched by any of the other banking stocks. They have a very nice dividend of around 3.5%. And so going into some tough times in the market, having cash flow coming in from a dividend stock that you can reinvest into this company or put into other areas that are going to get beaten down more is very attractive. It feels really bad when the market falls and you have all your cash tied up. And having a dividend that's going to pay you and is going to put money into your account that you can decide what you want to do with it gives you a level of flexibility that you don't have with normal stocks. So let me know what you thought about JP Chase, ticker symbol JPM, in the comment section down below. The second stock on this list is going to be Southwest, ticker symbol LUV. This is a stock that's already part of my portfolio, but I'm looking to add to it going forward. Right now, Southwest is trading for $38.50 and it's down 28% year to date in 2020. Similar to JP Morgan, Southwest has been very resilient to the overall market sell-off. While the market is down significantly, around 8 to 10% in the past 3 days, Southwest is up 1.5% overall. And so that's kind of beaten home the point that these beaten down stocks, sure, they can probably retest those lows that we saw back in March, but the overall day-to-day movement of it is not going to be as aggressive as what we've seen with the tech stocks. And so while airline travel has not come back fully, I think Southwest is the best airline stock going forward because of many factors. I think the reliance on domestic travel is going to be the main factor why they're the first to bounce back overall. As we've had these restrictions for international travel, they'll be able to get back to full capacity on their domestic flights compared to something like a Delta or a United that has a lot of international flight. And that process is a lot more complicated because many of the other countries have shut off their borders to the United States. And so Southwest has the ability to get back to pretty close to 100% much faster than the other airlines. Also, they have very low costs and they've gotten rid of a lot of the changing fees for their flights. And I think that's going to be a very attractive thing to people that are trying to make up for, at this point, we're going to go on 9 months of not being able to travel fully. And so I think when the demand comes back, the fact that Southwest is going to be the cheapest option is going to be very attractive for families that have been putting off travel for all of 2020. And so I think that'll be a huge increase compared to some of the airlines like Delta and American that are very reliant on business travel. And it'll be very interesting to see how business travel changes in the next couple years because we've shown with the pandemic that people can work from home successfully. So it'll be very interesting to see if business travel declines in the future or if it goes right back to where it was. So overall, I think the airline industry is going to be in a very good spot for a long-term investment. But there are some reasons, 3 specifically, why I think Southwest is going to be the best bet for a long-term investment. The first one is that they have the highest operating margin. What this means is the company is the most efficient at turning revenue into profit. And so as we've seen this decline in demand, upwards of 90% so far in 2020, what that means is that Southwest is going to be able to get back to net neutral for their cash flow quicker than the other companies. We've seen some stories about how crazy of the cash burns that some of these airlines have had. We saw stuff about American back in April that they were burning through $70 million a day because they did not have the same demand as pre-pandemic. And so what that means is that when things start going back to normal, Southwest is going to be the first to get their books back to pretty much normal, and it's going to take a lot longer for these other much larger airlines. Number 2 is that their financials look much better than the other airlines. They have seen a recent increase in their long-term debt to around $10 billion, but that's counteracted by their shareholder equity of $11 billion, which gives them a debt-to-equity ratio of around 0.8. And so when you compare this to the rest of the industry, it looks much better. Right now, Delta has a long-term debt to equity of 2.2, United has 2.3, and then American has 0 because they have negative shareholder equity. And then looking before the pandemic hit, they had a long-term debt to equity ratio of 0.3, which is incredible to think of for an airline that has to spend so much money on pretty much every part of their business. Every time I see it as 0.3, I'm very impressed. And so while it's not going to go back to that level anytime soon, the fact that they've spent all this money protecting themselves and their debt to equity is only 0.8, very bullish overall. And number 3 is just their overall business model. The focus on domestic flights, the removal of fees for changing their flights, and just how cheap of an airline they are overall. I think the demand is going to come back to Southwest quicker than the other airlines. At this point, we're going into a recession. Cash may be tight for a lot of families that have not been able to travel so far in 2020. So having a discount option, I think the demand is going to come back to Southwest in full force. Obviously, that might not be in 2020, it might be in 2021, but when it does come back, Southwest is going to bounce back faster than the other airlines. And those are the 3 reasons why I'm very bullish on Southwest, ticker symbol LUV overall. Let me know what you think about Southwest in the comment section down below. And then the last stock on today's list is going to be Chevron, ticker symbol CVX. So this is the first time I've talked about an energy stock in like a year and a half. I talked about PG&E, ticker symbol PCG, a long time ago, and I have not talked about it ever since. And so the energy sector has been in a really tough spot, similar to the pandemic. If you remember back in, I think it was April or May, the oil futures went negative for around 24 hours. So they've been in a really tough spot as the demand for oil and gas products has been so much lower than it normally is. But at this point, I think the oil stocks and the energy sector is in a much better spot. And I think it could be a great opportunity for a long-term investment. And so I was looking for what energy stock I wanted to talk about today, and I decided to pick Chevron instead of ExxonMobil because recently we had the switch where ExxonMobil was removed from the Dow Jones on Monday. And what's the only oil stock left on the Dow Jones? It's Chevron, so I wanted to talk about it. So the energy sector has not performed very well since 2012. When you look at the overall sector, it's down around 4% since 2012, and Chevron is up around 72%, so it is significantly outperforming the rest of the stocks in this sector. So currently Chevron is trading for $81 and it's down 33% year to date. So that 72% return that they've seen since 2012 is also taking into account the massive drop that the sector has seen in 2020. So looking at the 5-year chart, it's only returned 5% overall in a 5-year period, which is not ideal. However, I think there's a lot of potential going forward, especially from the fact that it's at a significant discount at this point. Also, I think demand will come back eventually. We're starting to see people go back to work pretty much fully, and the demand is likely going to increase in the future. And so I want to talk about the 3 reasons why I think Chevron is a very attractive buy for a long-term investment. Similar to Southwest, Chevron has a surprisingly low long-term debt to equity ratio. So we talked about Southwest that was at 0.8, and pre-pandemic they were at 0.3. And for an oil company of Chevron, I was really surprised to see that their long-term debt to equity is 0.25, which is incredibly low. And compared to the rest of the sector, this is really low, and that's one of the main reasons why Chevron was very attractive to me overall. When you have a certain level of uncertainty in a sector that has been beaten down recently, having a lower long-term debt to equity ratio is very attractive and probably was the main deciding factor why I decided to put Chevron on this list. Number 2, their dividend is very impressive to me overall. The CFO has come out and said that the recent price drops in crude where it went down to $30 a barrel was an important stress test to see the overall health of the company. And they decided that they did not need to cut the dividend at all, which was always a positive thing to see. And so we've seen some of the worst days for oil recently, and the company was able to hold the dividend yield of around 5.5%. And the company has talked about the importance of the dividend and increasing the dividend over time. And so as a long-term investor, that's beautiful to hear. And so the 5.5 isn't as great as what we've seen with ExxonMobil, which is at 8.1%. But the fact that the CFO has come out and said that it's going to be safe going forward, positive. And then number 3, I think it's the best energy stock in the sector. We can look at ExxonMobil, which has done decently well, but one of the things that spooked me away from ExxonMobil is because their dividend yield is too large. At 8.1%, considering how beaten down the sector is, it's a little scary. Anything over like a 5 to 6% range, that's where I start getting worried. And the fact that ExxonMobil is very high compared to the normal dividend for the sector has me a little bit spooked. And if they cut that dividend, I assume that there would be a major sell-off. And so Chevron overall, I think is probably the best energy stock out there. At this point, I have only done a little bit of research on the sector, and I'm going to be doing a full video on the energy sector in the next couple weeks. So let me know if you have a favorite energy stock, and let me know what you think about Chevron, ticker symbol CVX, in the comment section down below. So at this point, the stock market is in a very interesting spot. We've seen a fantastic couple months, and now we've seen a recent sell-off in the past couple days, and it'll be very interesting to see where the market goes in the next couple weeks. So at this point, I'm not going to be buying into any overextended tech stocks. That's why I decided to talk about these 3 stocks and these 3 beaten down industries of financials, the airline industry, and with the energy sector. And so these are stocks that are all down 25 to 30% still. And I think their downside risk is much better than the rest of the overall market. So let me know what you thought about this list. Let me know what stocks you guys are buying going into September. Thanks for watching. I appreciate all the support, and I will see you on Monday.